On December 5th, 2024, the price of Bitcoin broke the $100,000 mark for the first time. At such a historically significant moment, we might as well consider a question. Is $100,000 the ceiling for Bitcoin, or is it just the beginning of its rise? Perhaps a valuation model can give you the answer you're looking for. First, let's briefly understand the issuance process of Bitcoin. By running the Bitcoin open source software after the Genesis block, which is the first block in the Bitcoin blockchain, is created, a new block is generated approximately every 10 minutes, and Bitcoin is the reward that miners receive after successfully mining a block. Approximately 210,000 blocks can be generated in 4 years, and for every 210,000 blocks generated, the amount of Bitcoin rewarded is halved. For the first 210,000 blocks, each block rewards 50 Bitcoins for a total of 10.5 million Bitcoins generated in 4 years. For the second 210,000 blocks, each block rewards 25 Bitcoins for a total of 5.25 million Bitcoins generated in 4 years, and so on until around the year 2140, all 21 million Bitcoins will have been generated. As of November 29th, when this video was made at 7:15 p.m. New York time, 1989 million Bitcoins have been generated, accounting for 94.7% of the total supply. So, have you noticed? Bitcoin's halving mechanism actually simulates the mining of mines in our real life. Initially, the ore is easy to mine, and a lot of resources can be obtained each time. As time goes by, the ore resources decrease, making it difficult to obtain resources. The reduced output makes the resources scarce, increasing their market value. So, the Bitcoin valuation model we are proposing today is actually a model used to value scarce natural resources called the stock-to-flow model. The stock-to-flow model specifically for Bitcoin was a concept proposed in 2019 by a former institutional investor named Plan B. The stock-to-flow ratio is the ratio obtained by dividing the existing Bitcoin stock by the annual Bitcoin production. The higher the ratio, the scarcer the resource. Before the Bitcoin reward halving on April 19th of this year, Bitcoin's stock-to-flow ratio had reached 62, meaning it would take 62 years to produce the current total supply of Bitcoin, which is on par with gold, proving its scarcity. As of November 29th, due to the reward halving on April 19th of this year, the stock-to-flow ratio has reached 121, nearly doubling. And Plan B conducted a regression analysis on the historical data of Bitcoin's price and stock-to-flow ratio and obtained the following conversion formula. The price of Bitcoin is equal to 0.25 times the cube of the stock-to-flow ratio. Therefore, this formula can be used to predict the future price of Bitcoin. Let's look at this chart. The colored line is the historical price of Bitcoin, and the red line is the predicted price calculated by the model. As you can see, from 2012 to 2024, the Bitcoin price and the model's price trend have been largely aligned. For example, after the Bitcoin reward halving in May of 2020, the price of Bitcoin was around $9,000 while the model's predicted price was $55,000. Although the predicted price seemed absurd at the time, the price of Bitcoin actually reached $55,000 in February of 2021. So after the reward halving in April of 2024, the price of Bitcoin was $63,000. At this time, the stock-to-flow ratio was 121. If we plug this into the model, the predicted price we get is $443,000. We can say that history is repeating itself. Compared to the current price, the model's target price of $440,000 is simply outrageous. But this time, will you choose to believe it or will you choose to ignore it? Wall Street's views on the practicality of the stock-to-flow model are also polarized. Cathie Wood, as well as Michael Saylor, the boss of MicroStrategy, who went all in on Bitcoin, agree with the model's predicted upside potential. But at the same time, other analysts on Wall Street are skeptical of the stock-to-flow model for a few main reasons. First of all, the model relies entirely on historical data. While it matches Bitcoin's historical price, it cannot guarantee it will align with future prices. Many factors can influence the price of Bitcoin, such as inflation, regulatory policies, wars, and so on, and the stock-to-flow model cannot capture these factors. Furthermore, the model doesn't consider the demand for Bitcoin. Instead, it assumes that as more Bitcoins are mined, the number of people who want to buy Bitcoin will also increase. If we consider this issue from the perspective of Bitcoin's inherent properties, we'll find that this assumption doesn't currently hold up. Although Bitcoin has monetary properties, its high price volatility and relatively slow transaction speeds make it difficult to use for everyday payments as conveniently as traditional currencies. And many people now buy Bitcoin not for its intrinsic functions, but to speculate for profit. So Bitcoin actually lacks practical utility. And this lack of utility means that the general public will take a wait-and-see approach to holding Bitcoin, which in turn suppresses demand for it.